Japan is losing the fight to save its currency. They have been aggressively selling dollars to buy back the yen, but they're still crashing down to earth. Their currency intervention is failing. Now, Japan just did another intervention, burning away a record $37 billion last Friday. And yes, it did spike the yen up by 2%, but this strategy is not going to work for the long term. Remember, they tried to intervene in September for the first time, but the yen kept crashing down. It is still down over 22% year to date, and not much has changed. Japan is trying to play a waiting game with the Federal Reserve. They are trying to outlast the Fed with their dollar reserves, but time is not on their side. The Federal Reserve's number one goal is to crush inflation by destroying demand. They're going to continue hiking rates and keeping them high. Their dual mandate tells them that they can keep going because unemployment is still low, but inflation is out of control. The markets have already priced in a 75 basis points hike for November, and the Bank of Japan will have to keep burning through their reserves to save the yen. But Japan isn't just dumping dollars, they are also drawing down their US Treasury holdings. We have reports of Japan dumping their treasuries to fund their currency intervention. They are burning through dollar cash like no tomorrow. They spent nearly $20 billion in September, guys, and $37 billion last week to defend the yen. But it is not working. We can see that Japan's treasury holdings have fallen by 3% in August as bond prices continue to crash thanks to rising rates. We can see their holdings in black drop below $1.2 trillion, a 10% drop from their November high of $1.33 trillion. Now, it makes sense that Japan is dumping its US bonds because they need the cash, right? Rates are still going to go up and bond values are going to continue coming down over the next few months. So, if they front run the Federal Reserve and they liquidate their holdings now, they can retain more value today than tomorrow. However, Japan's currency intervention isn't going to work in the long term, and the yen is likely going to crash even further down. And here's the problem: the Bank of Japan is trying to do the impossible. They are trying to stimulate their economy during a period of rising rates while also trying to protect their currency from devaluation by doing currency interventions, right? However, that is not going to work. You cannot save both the bond market and the value of your currency at the same time. You will need to sacrifice one for the other. Now, what Japan has been doing over the past decade since 2013 is to continually print money to cause higher inflation to stimulate the economy. Yes, they've kept bond yields down, but the economy is still stagnating. Their easing hasn't been working. The Bank of Japan pumped their commercial banks full of money, right? They're flush full of cash, but the banks weren't loaning out the cash, and the local Japanese people weren't going out to borrow and spend either. They rather save money. But then 2022 came, and the Fed started to hike rates, and Japan's inflation started to rise. Now, inflation is now 3% in Japan, the highest it's ever been in 1999, and a big part of it comes from rising commodity prices and energy as well. But Japan has another big problem, and that is contributing to soaring prices, and that is a currency depreciation. Yes, Japan is a huge exporter of products, but also a net importer of raw materials, especially when it comes to food and fuel. And all those are priced in US dollars. And as the yen continues to crater, inflation in Japan is going to continue to rise. And it's not because Japan has a tsunami of cash sloshing around, but because the yen is extremely weak and now they have to pay more for commodities. And this is the problem of trying to solve your economic problems through monetary policy instead of tackling the fundamental issues. And one of these issues is Japan's aging population and low birth rate. Now, by 2045, the majority of people in Japan are going to be nearly 50 years and older. That is destroying their productivity and the local consumer base. And no amount of money printing and keeping rates low is going to solve this problem for the long term. However, the BOJ is committed to keeping rates low so that the government can keep borrowing money at low interest rates. But here's the deadly cycle of currency devaluation Japan has trapped itself in. We can see that the yields on the Japanese bonds, the JGBs, they are a joke. The yield on a 5-year is almost zero, and the 10-year is not even 25 basis points. There's no point putting your money in Japanese debt when the yield is so low. And the Bank of Japan is committed to keeping inflation high. In fact, they want even higher inflation. And that's why investors and funds, they are dumping Japanese bonds in record amounts. They know the BOJ has lost their minds and it's time to hit for the exits. We can see over 6 trillion yen of bonds were sold in September alone, making it the biggest drawdown over the last 20 years. And guess where the money is flowing into? They are running to US treasuries. According to Bloomberg, Japanese funds were net buyers of 565 billion yen of US sovereign bonds. So money is leaving Japanese bonds and investors are selling the yen for dollars in order to buy treasuries. And this is where the doom loop comes in. Because investors are leaving Japanese bonds, the yields should spike. But the BOJ wants to keep them low. So what does this mean? A whole lot of money printing to force the yields down. Now the money supply has expanded even further now. Investors see this and they're gonna say hell no. And they are beginning to sell off their yen even further, causing depreciation to get even worse. If we take a look at the yields on the 10-year treasury versus the 10-year JGB, we can see a huge differential of over 4%. And this is why the yen is getting devalued. The Bank of Japan's message to investors is clear, and the Federal Reserve's intentions are also crystal clear. Japan is going to keep printing money to keep yields low, while the Federal Reserve is going to keep hiking rates to wrestle down inflation or until something breaks. And this is why Japan's currency intervention is going to fail in the long term. There's no fundamental case to hold the yen. There's no organic demand for it. Japan might be able to keep selling their reserves for 6 months or even up to a year to defend the yen, but eventually they will fail. And Japan will be left in a very dangerous position. They would have exhausted a ton of their dollar reserves and they would have printed up a bunch of yen to keep their bond yields down. And what do you think this will cause? A further capital flight away from the Japanese yen. They'll be back to square one and in a worse position because their dollar reserves are now depleted. And if there's another supply shock that causes commodities to spike, maybe it's the Ukraine war escalating even further, China invading Taiwan, or maybe OPEC cutting production, then Japan is screwed and their inflation will get out of control. And it's not like we have not seen this before. We have seen what happened in the UK with Liz Truss, who tried to stimulate growth through tax cuts and deficit spending. Investors began leaving the pound and the British gilt market broke, and the Bank of England had to intervene with QE, and the same thing is happening with Japan. But they are trying to save both their bond market and currency at the same time. This is going to be a train wreck. They don't have unlimited reserves to sell dollars and buy back the yen. Now, what if the Federal Reserve keeps hiking rates for the next 6 months and then they keep rates high for the next year or so? Does Japan have enough reserves to defend the yen for 18 months straight? At their current reserves of $1.2 trillion, they have enough for 14 months or so of imports. Now, is that enough? And because they are trying to prevent a bond market collapse, they are printing tons of yen. And this adds even more inflation pressure and shows investors that your economy is extremely weak. If your central bank has to intervene directly time and time again in your bond market, it shows us that there isn't any organic demand for your debt. No one else is buying. And this is why the Bank of Japan will have to pivot down the road. Their currency reserves are going to run out and inflation is going to get out of control. And then Kuroda will have to make a choice. Will he let the bond market break and let yields rise and plunge Japan into a deep recession? Or will he just keep printing money and let the inflation Godzilla destroy Tokyo? Will he sacrifice the currency to keep the economy afloat? Now, a big question that keeps coming up is if there's going to be a global dumping of US dollars. Something like the Plaza Accords where countries all over the world come together and try to stabilize world currencies. But that will depend on the United States also coming on board with the idea to devalue their currency, right? And guess what? The US is not interested in playing ball to stabilize the currency markets. Now, in the report, we have the G7 failing to reach an intervention deal to fight against the soaring dollar. Japan and the United States are at odds with each other when it comes to this currency crisis. We have Japan's Finance Minister Suzuki threatening more interventions, saying many countries saw the need for vigilance to the spillover effect of global monetary tightening and the mentioned currency moves in that context. But there wasn't any discussion on what coordinated steps could be taken. But just listen to the US response from Treasury Secretary Janet Yellen. She has expressed no interest in any Plaza Accord 2.0. She said, I've stated on many occasions that I think a market-determined value for the dollar is in America's interest, and I continue to feel that way. So Japan is out of luck and they're on their own. The US government will continue to let the dollar strengthen and destroy world currencies because it benefits them. Remember guys, the end goal of the Federal Reserve, and I have to say it again and again, it is demand destruction. By allowing other currencies to depreciate, you can cause demand globally to crash and inflation to come down. especially when it comes to energy. And a stronger dollar is an advantage for the US because it allows cheaper imports for the country. And if they embark on another Plaza Accord, a weaker dollar will mean domestic inflation in the US will soar even further. So Japan has to wake up. They have to realize that the cavalry isn't coming. There's no rescue squad coming, and the US isn't going to weaken their currency for them. Japan will have to realize their reserves are unlimited. Investors will continue dumping the yen because the BOJ is hell-bent on printing money to save their bond market. So what can Japan and other countries do when it comes to fighting against rate hikes? Now, the most obvious solution is also to hike rates together with the Federal Reserve and ride out the recession storm. If power tightens, you gotta tighten as well to increase investor confidence in your local currency. If you try to stimulate your economy during a period of global slowdown, you are just gonna crush your currency even further. Another option is to have bilateral deals or swap lines with other countries you can tap on to buy commodities and imports. For example, the Bank of Japan has a $75 billion swap line with India where they can exchange yen for US dollars from India. And this will keep the yen from flooding the currency markets while allowing Japan to get more dollars and buy more time. They can use the dollar to sell on the spot market or import more raw materials, right? However, this is just a delay tactic, guys. Unless the BOJ decides to hike rates, they are just left with this one strategy: currency intervention. And the success depends on if the Federal Reserve will break first. Japan is playing a game of chicken which they'll likely lose. They are trying to use their limited stockpiles of dollars versus the Federal Reserve, which can simply print the reserve currency. They won't win. Sooner or later, the BOJ will have to make a deadly choice. Do they let their bond market collapse and let Japan go through a recession, or keep draining their reserves to the point where they are vulnerable to a systemic shock? Because at that point, if Japan doesn't have enough dollars to import stuff, the yen is toast, they might have to go to the IMF for a bailout. So let me know what you think. Will Japan pivot and start hiking rates, or will they continue selling dollars until their reserves are empty? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these inflationary times.